So, let's talk about something that sounds incredibly boring but could potentially set our economy on fire. Private credit. Think of it as the financial world's version of a secret, exclusive nightclub. While regular businesses go to a normal, brightly lit bank for a loan, others now go to this shadowy, VIP-only lender. This market has absolutely exploded since the 2008 financial crisis. Back then, new rules like the Dodd-Frank Act were put in place to stop banks from making outrageously risky bets. The idea was simple: make banking safer. But finance, being finance, simply found a new, less regulated place to get its thrills, and that place is private credit. Just how big has this gotten? Well, in 2010, the entire private credit market was worth about $300 billion. Today, as of mid-2025, it's a colossal $2.1 trillion behemoth. That's not just growth. That's the kind of growth you see in a sci-fi movie right before the monster escapes the lab. The fuel for this rocket ship has been a decade of super low interest rates, which sent investors on a desperate hunt for decent returns. Private credit funds promised exactly that, offering juicy yields of 8 to 12%, making them irresistible to pension funds, endowments, and even wealthy individuals who were tired of getting pennies from their savings accounts. But what exactly is it? At its core, private credit is just lending money directly to companies, usually medium-sized ones, without involving a traditional bank. Instead of a loan from JP Morgan or Bank of America, a business gets its cash from a specialized investment fund run by giants like Apollo, Blackstone, or Ares. These companies, often owned by private equity firms, need money for things like acquisitions or expansion. For them, private credit is often faster and more flexible than a bank loan, with fewer annoying questions and less paperwork. It's the financial equivalent of getting a loan from a cool, laid-back uncle instead of your strict, rule-obsessed father. This arrangement sounds great for everyone involved, right? The investors get high returns and the businesses get quick cash. The problem is what you don't see. Unlike bank loans, which are highly regulated and publicly reported, these deals happen behind closed doors. The terms are secret, the risk assessments are done internally, and the whole system operates in a murky twilight outside the view of pesky regulators. This secrecy allowed the market to swell to an immense size with almost no one paying attention, creating a perfect environment for risks to quietly multiply, just waiting for the right moment to emerge and say, "Surprise!" Now you might be thinking, okay, so some rich funds are making risky loans. How does that affect me? Well, that's where the term shadow banking comes in, which sounds like something a Batman villain would major in at business school. It's a broad term for all the lending and financial activities that happen outside the regulated banking system. Private credit is the undisputed king of this shadow realm. It mimics the functions of a bank, taking money from investors and lending it out, but without any of the safety rails, like deposit insurance, strict capital requirements, or public transparency. It's like building a skyscraper without a single building code. The real danger here is interconnectedness. The shadow banking world isn't a completely separate universe. It's deeply and frighteningly linked to the regular banking system we all depend on. You see, the big regulated banks that we were trying to make safer after 2008 are now major lenders to the private credit funds. In fact, US banks have more than $1 trillion in exposure to these non-bank lenders. So, while a bank might not be making a risky loan directly to a struggling company, it is lending a massive pile of cash to the private credit fund that is making that exact loan. It's a loophole big enough to drive a Brinks truck through. This creates a terrifying domino effect. If the companies borrowing from private credit funds start to fail, and we'll get to that, the funds themselves will take huge losses. When those funds get into trouble, they might not be able to pay back the enormous loans they took from the big, stable, safe banks. Suddenly, the crisis that started in the shadows comes crashing into the light, threatening the entire financial system. Regulators have been ringing alarm bells about this for a while. The Financial Stability Oversight Council even flagged private credit as a potential source of market stress in 2024, which is regulator speak for, "We are officially freaking out about this." On top of this, the risk assessment in this market is a joke. Because there are no public reporting standards, the credit quality is often self-assessed by the lenders themselves. They use their own internal models to decide if a loan is safe, which is like letting a student grade their own final exam. This creates what's known as shadow credit ratings, where a loan might be presented as perfectly healthy right up until the moment it spectacularly defaults. This lack of transparency means no one, not regulators, not other investors, and certainly not the public, knows how much risk is truly lurking in the system until it's far too late. For years, the private credit party has been raging with free-flowing cash and seemingly endless returns. But as we stand here in mid-2025, the music is starting to sound a little off-key, and some of the guests are looking decidedly unwell. The first and most obvious warning sign is a rise in defaults. Several high-profile companies, many owned by private equity firms, have suddenly defaulted on their private loans this year. These failures have sent shockwaves through the portfolios of the funds that lent them money, revealing just how quickly the value of these supposedly safe assets can evaporate when reality hits. Another major red flag is the falling value of the very companies that private credit lends to. The valuations of many mid-sized businesses, the bread and butter of this market, have reportedly dropped by 10 to 15% in 2025. This is a huge problem. Many loans were made when these companies were valued at their absolute peak. Now that their worth has declined, the loans look much riskier. It's like giving someone a mortgage for $1 million house, only to watch the house's value plummet to $850,000 a year later. Suddenly the borrower has less to lose and is more likely to just walk away. In response to these emerging dangers, the lenders themselves are getting nervous. After years of offering incredibly generous terms with very few conditions, known as covenant-light loans, they are finally starting to tighten their belts. We're seeing them demand stricter terms, higher interest rates, and more protections for themselves. The overall flow of new deals is also slowing down, a clear signal that the industry's top players feel the ground shifting beneath their feet. This cyclical nature, known as pro-cyclicality, is a classic feature of financial bubbles. Lenders are overly generous in the good times and then slam the brakes on credit precisely when businesses need it most, worsening any downturn. Even the titans of Wall Street are sounding the alarm. JP Morgan CEO Jamie Dimon, a man who knows a thing or two about financial meltdowns, has been publicly warning that the private credit market could pose a systemic risk, especially if the economy stumbles. He's essentially pointing at this massive, unregulated market and saying, hey, remember that thing that happened in 2008 with subprime mortgages? We're kind of doing it again, just with a different name. When the person running America's biggest bank tells you there's a problem brewing outside his window, it's probably a good idea to listen. So, with all these warning signs flashing and a $2.1 trillion pile of opaque debt looming over the economy, the big question is, could this trigger the next financial crisis? The honest answer is, maybe. Analysts don't foresee an immediate 2008-style collapse tomorrow, but they agree that the system's vulnerabilities are growing by the day. The lack of transparency, the deep connections to regulated banks, and the sheer amount of leverage involved have created a system that is incredibly fragile. It might not be the initial spark, but it could act as a massive amplifier for the next economic shock, whatever it may be. The risk has also spread beyond sophisticated institutions and is now being sold to ordinary retail investors. Firms are packaging private credit into evergreen funds, making them accessible through wealth advisors. This introduces a dangerous liquidity mismatch. The funds hold illiquid loans that can't be sold easily, but they offer quarterly redemptions to their investors. If a wave of fear causes investors to rush for the exits, these funds could be forced to gate or halt withdrawals, creating a panic that could spill over into the public markets. We're essentially inviting Main Street to a party that could end very, very badly. So what can be done? The first step is simple, yet seemingly impossible for modern finance transparency. Regulators need to drag this market out of the shadows and into the light. This means demanding standardized reporting for loan performance, risk metrics, and valuation methods. We cannot manage a risk that we cannot see. Secondly, we need to seriously examine the connections between regulated banks and these shadow lenders. If banks are simply outsourcing their risk-taking to a less regulated entity, then the post-2008 rules have failed, and we need to close those loopholes before they bring the whole house down again. Ultimately, this matters to everyone, because the bill for a financial crisis is always paid by the public through job losses, economic stagnation, and taxpayer-funded bailouts. We've seen this movie before. A new, complex financial product is hailed as a brilliant innovation. It grows to an astronomical size in the dark corners of the market, all while regulators are either asleep at the wheel or powerless to act. Then, it blows up. It's time to demand action and impose sensible rules on private credit now, before this trillion-dollar problem becomes everyone's crisis. We can't afford to learn the same lesson a third time.